Simon Brown here. I'm going to be moderating this webcast with the 10X investment crew. We've got Brett McKay, investment consultant, Chris Eddy, head of investments. With Chris on the line, it means we can delve into a bit of thinking around valuations in the US and the like. We can also look at a conversation I've had with Chris before, which is at these levels of valuations, what do your returns look like going out over the next decade or so? And of course, Brett will talk practical products, the process. As always, we're not giving individual financial advice. That is beyond the remit of this webcast, but you're always welcome to contact the 10X team. They can help you directly in that regard. Brett, Chris, appreciate the time this morning. Brett, I want to jump straight into I think what's a fairly important point for retirees of all retirees. It doesn't matter if they've done well and they've got a good retirement nest egg, or if they perhaps a little light on it. But one of the questions I imagine which is always coming through is, how do we increase income? How do we make more of our pot? And there are, I suspect, a couple of levers that we can pull for those who want to try and get some more from their retirement.
Hi, Simon. Yeah, thanks so much for having me. Yeah, obviously starting off with regards to you increasing your income in retirement, I think it's very important to control the controllables, especially when it comes to a long-term retirement investment. And when we talk about controllables, we talk about controlling your fees and your costs of running your investment. So if you can reduce your costs, naturally that's going to mean more for you in your back pocket at the end of the day, or more that can go back into the fund and grow your capital. There are some things that are uncontrollable. We talk about inflation, we talk about the returns of your investment. But if you, an investor, can understand what you're paying in your fees, understand your costs, understand what's leaking out of the investment, you can then go and plug those leaks and pay yourself more. So yeah, control what you can is basically what I'm saying.
Yeah, folks, if you've got questions, you're welcome to drop them into the Q&A box. We've certainly got some time for that. Brett, the key number that matters when I'm looking at fees, because there's a lot of moving parts, is the EAC. That is like the sort of the king of fees, and that's the total tells us everything we need to know.
Correct, yeah. So your EAC is essentially a summary of all the fees that are charged on your investment. It's typically made up of a couple of different layers. So, we look at your advice fees, you look at your investment portfolio fee, administration charges, performance fees, other costs that might come into the product. So if you can get your EAC, you can ask your provider for your EAC. It's a legal document that they are required to give you. And that will essentially give you a summary of all the costs that you are paying on that investment. And once you get that, it's really useful, because then you can go and look around and see what other EACs are from different providers. Like I said earlier, naturally the lower cost and the less fees you are paying, the more that goes into your back pocket. So yeah, the EAC is a really important aspect of understanding your investment and knowing if you're getting bang for buck with regards to the living annuity.
And whether I'm pre-retirement and I might be in a Reg 28 product of some sort, or I'm post-retirement and I've got a living annuity. We'll park guaranteed annuities aside. We'll get to them at a point, but for now not. If I've got an EAC which is eye-watering, and there are certainly some out there, I can switch providers. I mean, it's a process. There's some paperwork, but switching is very, very possible and doable.
Yeah, 100%. So with a pre-retirement investment, like a retirement annuity or a preservation fund, you can switch providers doing a Section 14 transfer, where a living annuity, it's called a Section 50 transfer. So with regards to that Section 50 transfer, it's nice because there's no disruption in the income when you're switching providers. It's a common question I get from living annuity clients is, okay, I'm happy to switch across, but now what happens to my income? Is it a new anniversary? Do you get a new income? But basically, we transfer the fund as is in a living annuity. You keep the same anniversary date. All you're doing is switching your providers. We pay the income to our clients on the same day of every month. That is if they're taking a monthly income. So yeah, it's a relatively seamless process to switch providers. We generally see with living annuities, there's no costs in switching. With regards to retirement annuities and preservation funds, it is different for every person. It depends on the kind of policy they've set up, how it was structured at the beginning, if there's commission to be paid back to the broker. But that it usually will say on the statement if there are any termination values or exit costs when you're switching providers.
Yeah, so you've been kind there, and I'll tell my story, and I've told this before. I once moved an old legacy retirement annuity taken out in 1994, and my legacy provider charged me about 2 arms and a leg. But when I ran the numbers at the lower fee structure, it was still cheaper to pay the 2 arms and a leg and get onto a lower cost. Chris, I want to bring you in because increasing income, everyone wants more. That's fine. We're quite comfortable with that. Then one of it is, well, AI, the US is 18, NASDAQ is up 18% this year. Gold's running. We got to be careful of FOMO, and we've also got to be careful of valuations. What matters with income, perhaps more than how much did I do this year, is what's the sort of consistency and reliability of it into the future?
It's a great question, Simon. And I think even before we get into anything to do with the current environment, it's always useful to take a step back, because I often find when you are making an investment decision in your living annuity, you're typically choosing some sort of risk profile, either a higher risk portfolio with lots of equities and growth assets, or a much lower risk portfolio, maybe an income fund or a low equity portfolio. We've done a lot of modeling over the long term, and we've looked. I mean, if you think about it, if you retire at 65, you might actually be living for another 30 years. So you actually have a very long-term investment horizon. And when you think about what your objective is, let's say you want to pay yourself a 5% salary as a percentage of your assets. Well, you need to grow your assets 5% above inflation to keep giving yourself an inflationary increase every year. And over long periods of time, the only way to really achieve that has been through a portfolio with 70-75% equity through the cycle. I mean, on average, sort of a high equity balance fund gives you about inflation plus 5 to 6, somewhere in that region. So that is something that you need. But if you do select a portfolio that has quite a high allocation to growth assets, you'll probably sleep pretty well over the long term, but you might have to deal with a lot of volatility on a day in and day out basis, and how one manages that emotion over the shorter term. You need to know that, well, that's the price. Short-term volatility is the price I'm paying for higher long-term returns. And actually, conversely, if you make the choice to say, I'm going to invest defensively for 30 years, you might sleep very well tonight and tomorrow night and the next night, but you might actually find that combination of inflation and your drawdown erodes your capital over the long term, and you struggle to kind of pay yourself those higher fees. So I always say it's like, understand what trade-off you're making, whether you're investing conservatively or aggressively, so that you can manage your own expectations, whether that's over the short term or the longer term. Now, maybe one way to think about it is to say, well, if I do invest quite aggressively today, and I'm taking a really low drawdown, it actually doesn't really matter. I mean, we've run the numbers. If you take a 2.5% drawdown and you pay 1% in fees, over any 30-year period going back over the last 130 years, you would have always been able to pay yourself an inflationary increase, because you're pulling out such a little bit of capital. However, if you're taking quite a large drawdown immediately, that's when you potentially subject yourself to sort of sequence risk, and what happens if the bubble in US equities or the AI bubble bursts next year or the year after that, and in your first 1, 2, or 3 years you have a big large market sell-off like we saw in 2008 or the early 2000s, and you pull a lot of capital out, you might not be able to benefit from the rebound, whether that's 2, 3, or 4 years later, and ride out the longer term. So it's in that environment, I think, where investors need to be cognizant of the decision that they're making.
And asset allocation is so important. I mean, you mentioned living to 95. I actually got an email recently from someone whose grandmother had retired 39 years ago. They're 104. So, I mean, but there's also that thinking, and I used to fall into this trap way back in the day where, when you get to 65, move into cash and bonds because you don't want risk. But to your point, you've got decades of investing. You might take more cash and bonds than a 30-year-old would have, but you need that equity because you need that growth, because you need it to keep up with inflation and give you the return over decades. This isn't a sort of turn off the risk profile at 65.
Completely. I mean, to that point, I mean, the other thing though there is that one potentially does need to segue to where we are in the market currently today. And I think there is a little bit of a trade-off there. I mean, you alluded to kind of expensive valuations in the US. And again, the way I like to think about it is take a step back. This is, again, somewhat of an expectations management exercise. The last 5 years have been a fantastic time to be invested in markets. Again, I'm going to use a proxy of a high equity balanced fund in South Africa. It's delivered the average fund, not the best performing fund, the average fund has delivered something in the region of CPI plus 8 to 9%.
Wow.
Over the last 5 years. On average, that typically has been somewhere between 5 and 6%. So if you get back to that average of CPI plus 5 to 6%, kind of the next 5 years could easily be CPI plus 2 to 3 to kind of go together with the fantastic returns that we've seen through the rearview mirror. And we know that markets are cyclical through time. So again, I think people do need to bake into their expectations that the last 5 years shouldn't be the expectation going on indefinitely. And a big part of that has been the big push up in valuations that we've seen in US equities. And we know that US equities make up something like, I think I looked at it this morning, 72% of global developed markets. So almost the way that the US goes, the way global equities go in aggregate. And at these starting levels of valuations, they've only really been seen during the TMT tech bubble in late 90s, early 2000s. And we know that the decade that followed that was the last decade in US equities, where US equities delivered zero real return for 10 years, something that I think many of us looking at the last 10 to 15 years will find very hard to believe.
Yeah, I agree on that. I mean, I'm old enough to have been around in that .com boom, and I remember the decade that followed, and it was quite wild. And equally, a lot of folks were offshoring money, buying dollars and dollar assets, and got nothing in a decade. Brett, I want to come back to you. We're talking living annuity. So as I enter into retirement, I take my Reg 28. There's some tax to be paid and the like, but then I need to buy an annuity. And let's say I've got a living annuity. There are restrictions on terms of that drawdown. I got a couple of questions around drawdowns. What is my max and minimum, and what's my ideal sort of number? Is it that sort of 4 to 5% drawdown rate?
Yeah, perfect. So the minimum you are able to take from a living annuity is 2.5%. The maximum is 17.5%. We generally say if you can get a 5 or 6% drawdown, you should be in the sustainable sweet spot, meaning your million should stay R1 million while drawing an income. If we look at a 6% drawdown, that roughly means for every R1 million you have invested, you can pay yourself a salary of about 5,000 Rand per month. So 2 million, 10,000, 3 million, 15,000. You really want to make sure that the fund is sustainable. Obviously, if you go over that 6%, you will eat into the capital over time. But also, as we spoke about earlier, it's also important to make sure that you grow the funds while taking that drawdown. So if you're getting a 12% return and you're taking a 5% drawdown, you have enough room there for inflation plus fees. And I think this is where the living annuity equation comes into play. You always want to make sure that your fees plus your drawdown plus inflation are always less than the expected return from your fund. If you can do that, then you should never run out of capital, and your investment value should grow every year.
Yeah, and then importantly, you can then leave the living annuity to your heirs, whoever they might be. You also mentioned two other questions on the capital out of a living annuity. You mentioned monthly. So I can do a monthly, or what are the frequencies that I can select for money? Because I had thought it was sort of an annual plan, but I can do different periods.
Yeah, great question. So one of the biggest benefits of living annuity is the flexibility. So you're able to change your income on an annual basis, but you can also decide if you want to pay if you want to get the income paid to you on a month-to-month basis, biannually, quarterly, or annually. I find most clients will take the monthly income just because it helps them with debit orders, medical aid, kind of the day-to-day expenses. But we do have some situations where the client will want the entire lump sum as an annual income, and then they can structure it in terms of a monthly salary themselves. So it is flexible. You can decide on what you like to do. And yeah, like I said, it's one of the real benefits of a living annuity is still having some flexibility and not just, handing over the capital and that's your income. I've got a lot of clients, for example, who will start on, say, a 5% drawdown, and then the following year they maybe want to go travel or see the grandkids or do something different. They can then increase their income to 10%. When they come back, they can then drop it down. So it's nice having that flexibility. Yeah.
And tax treatment, I mean, is the money out of a living annuity is, as far as SARS is concerned, is income, am I right?
Correct. Yeah. So at inception, when you are retiring from your retirement funds, if you haven't taken a previous withdrawal from a retirement fund or a severance package, you've got 550,000 Rand that you can take tax-free. It does go up the more you take in terms of the retirement tax tables. And then once the funds go into the living annuity, it's structured as your marginal income tax rate. So we'll pay you the income after the tax has been taken off, like you would get a salary from your company.
Chris, to bring it back to you, and I liked your point you made around managing expectations. And the one thing that we've seen in South Africa, which I think might be a shock to many, but is a stark reality, is our inflation rate. It came out at 3.4, which is above, and I stress the word, the anchoring 3 number for the MPC. We are kind of shifting into, when I think inflation, I remember the high teen inflation of the 80s and 90s. Those days really are gone. And I appreciate that individual inflation is seldom what Stats SA tells us. That's another expectation to understand that all things equal, and if the Reserve Bank does their job well, no reason why not, we're in a 3% inflation world going forward, which is a whole different mind shift for us as investors.
That's right, Simon. Sorry, and before I answer your question directly, just to finish off on Brett's last point, all the growth on your capital within a living annuity is effectively tax exempt, which I think is a very important consideration for many investors when they might have assets sitting outside of a living annuity that the income's either subject to income tax or capital gains tax if they withdraw that money. If you are looking for sort of a bit of a tax shield for growth of assets, living annuity is quite a nice vehicle for that. But kind of coming back to your more specific question, you're absolutely right. And look, I think if you listen to the governor, he's been gunning very hard for 3%, and this is kind of the new target that they want to move towards. We still have to really get the official word from National Treasury on it. But I think one potentially, hopefully we do stay there, but I think one also might need to be careful in terms of like a recency bias there. I mean, if you cast your mind back 12 to 18 months ago, coming out of the election, we had the Rand was very weak. There was a lot of uncertainty in South Africa. You also kind of had the tail end of whether it was sort of conflict in Russia, which is ongoing. But the starting point is that you had a combination of a much weaker Rand and a much higher oil price. And really, if you look at it over the last 12 to 18 months, South Africa's massively benefited from a significantly improved terms of trade. So what does that mean? Well, our big exports are gold and platinum, and we've seen how those have absolutely been screaming and gone through the roof. So we earn a lot of dollars in for that. And our biggest import is oil. And the Rand price of oil has absolutely collapsed over the last 12 to 18 months. And that's really put a lid on inflation. And actually, I would almost make the point and argue that the Reserve Bank governor's move and really sort of quite tactical move to target the lower inflation number is in response to lower realized inflation. But we do know that if we do go through a period of Rand weakness, or I see the oil's popped again this morning because there are new sanctions on Russia, we could find ourselves back in a higher inflationary environment. But despite that, the lived and experience has been that inflation has been low for the last year, call it 3.5%. And again, a high equity balance fund has given you something like 14, 15, 16%. You think about that, that's a real return of 11, 12. Again, lived experience has been fantastic. We've really enjoyed strong real returns. And the big question is going forward, how can investors continue to deliver returns above inflation? On the one hand, we kind of mentioned, sorry, go for it, Simon. You want to?
No, I was going to say, because that's just it. If I'm a retiree, I'm sitting here, I'm getting, real positive, solid returns. It's great, make no mistake. It's lovely because my portfolio is growing. I can do my drawdowns, as you mentioned. within the living annuity, that growth of the portfolio is tax-free. But we mustn't get too comfortable with this, because we don't know what the next decade or two is going to be. But I would wager it's not going to be this good for every one of those years in the next decade or two.
I think that is spot on, Simon. And again, it's about, goes back to managing that expectation. If you're going to invest very aggressively today, know that that's going to come with a lot of volatility, and stick the course. If you panic while you go, if the market is off 20 or 30%, and you panic while the market's at the bottom, and then you move to a defensive portfolio, that's actually locking in the losses, and that's how you really destroy capital wealth. I mean, one question we often get from some clients is to say, well, okay, we're in a living annuity now, we're not subject to Reg 28. The last decade, global equities have trounced every asset class. Surely that's where we want to be invested. And you have the ability to do that in a living annuity. Again, I want to kind of, the starting point for thinking about this from my perspective is always to say, what's a sort of through the cycle expectation? And then assess where we are currently. And again, we've done a lot of back modeling, and we've kind of we've taken a high equity balance fund, and we've gone from everything from 100% onshore to 100% offshore. And we've looked at the problem through the lens of income sustainability. What is the probability that I will continue to be able to pay myself an inflationary increase? And the outcome that I think people can picture is a bit of a smile, where 100% offshore or 100% onshore increases your probability. Both of those options increase your probability of not being able to pay yourself an inflationary increase. I mean, the numbers that I've done put that somewhere at about 30% over a 30-year time period. So almost 1 in 3, if you're 100% onshore, 100% offshore, you'll get to a point where you won't necessarily be able to pay yourself an inflationary increase. And the sweet spot is really kind of between about 40% offshore and 60% offshore. You can, like, the bottom of that smile is kind of the sweet spot. And that makes sense because that's quite a well-diversified portfolio that can do well in a number and a range of different environments. So it's not an all or nothing bet on one outcome. And I think that's probably an important consideration when investors are trying to decide at this point how much to invest onshore and offshore. And the good point about that as well is that actually typical, I mean, if you go back 5 years ago, Simon, I'm sure you'll remember this, it was almost a swear word to suggest investing in a Reg 28 fund in a living annuity. SA equity, where it was one of the worst performing asset classes. It was like inflation +2 or something like that. And you were limited to only 30% offshore in a Reg 28 portfolio. You now can hold up to 45% offshore in a Reg 28 portfolio. And that fits somewhere between that 40 and 60% offshore exposure. So actually, the Reg 28 portfolio of today is very different from the Reg 28 portfolio of 3, 4, 5 years ago, and could still be a suitable investment vehicle for living annuitants today.
Yeah, and notwithstanding, very impressive numbers from the NASDAQ this year, very impressive numbers from the S&P 500. The top 40 trounced both of them in rands and in dollars. So it plays perfectly to your point. Brett, I want to come back to you, and I want to touch quickly on guaranteed annuities. And these are insurance products. It's not a 10x product, but it's different to a living annuity, and a lot of folks might want to do a bit of a blend of each. I'm thinking, I mentioned inflation, the 3.4 number doesn't always feel like my inflation number, but particularly in terms of medical inflation. And that's where a guaranteed annuity can be a helpful tool to look at it as a holistical view.
Correct. Yeah. So I think both living annuities and guaranteed annuities have their pros and cons. For example, with a guaranteed annuity, you're locking in an income for life. You're giving over the ownership of the capital to the insurance company. They're giving you a set income for life, and you don't have to worry about market volatility. You can get that set income, cover the basic expenses. Whereas regards with the living annuity, like I said, you have a little bit more flexibility. You can update your income, you can increase it, you can decrease it. So if you want to, you can do a hybrid. What we call a hybrid is where you do a split between the two, locking in a portion of the income from the guaranteed annuity for the medical aid, and then the other portion for a living annuity. And what we also find as well is with living annuity investors, you don't have to only have one living annuity. I see often that clients will open more than one living annuity, split it up, and then stagger it into guaranteed annuities down the line. Because once you go into a guaranteed annuity, essentially that is the end of the road. You can always change from a living to a guaranteed, but you can't go the other way around. You can't go from a guaranteed annuity to a living annuity. So if you are looking to lock in a portion, you are able to do so, but like I said, you can phase it in through multiple living annuities, say over a 5-year period, then a 10-year period, then a 15-year period, depending on the rates that you're getting at the time. But it also does depend on if your income's sustainable. I mean, if your income is sustainable and you've got a 2.5% drawdown, essentially, you don't really ever need to go into a guaranteed annuity because your income is sustainable and your investment will grow. It is different for every person, depends on whether they want to be invested into the markets or not, but also just in terms of, giving up ownership of the capital. A living annuity, often you don't nominate a beneficiary, and if you do, it might reduce your income. Whereas a living annuity, you nominate a beneficiary, and it becomes a death benefit if something happens. So passing it down, where, like I said, a guaranteed annuity, it will stay with the insurance company if something happens.
Yeah,
I mean, just on that, sorry, Simon, just a quick one on that in terms of what Brett raised. If you do go an inflation-linked guaranteed annuity, and this is the point I think that you've been driving home, right, is that you're getting an increase this year of 3.5%, but your medical aid inflation is at 10%. There actually, funnily enough, might be an asset liability mismatch there between an inflation-linked guaranteed annuity because of what official inflation is and ultimately what the lived and realized inflation level is.
Yeah, if you're going with the guaranteed annuity, the advice is read the T's and C's, because they come in 100 different flavors, and you've got to make sure that you understand the one that you're getting. Brett, a question coming through around moving. I can move a Reg 28. Can I also move a living annuity? My sense is you absolutely can.
Yeah, correct. So it's called a Section 50 transfer. What's nice about that transfer is there's no disruption in your income. Income will continue to be paid. You keep the same policy anniversary date. Depending on the company that you deal with, for example, 10X will handle the transfer on your behalf. You set up the account, we send the instruction to the current provider and help you move it across. Fairly straightforward process. I think people look at switching across just to lower their costs and look at some better performing funds.
I want to touch back on you talked around when a person passes, the guaranteed annuity will park aside. A living annuity, how is that part of the estate? Where does it fit into the estate picture?
Yeah, great question. So it's not part of the estate. Upon death, it becomes a death benefit for the beneficiary. They can then decide if they want to take the investment as a lump sum. When they take the lump sum, it's taxed in the deceased person's hands in terms of if they use their 550,000 Rand allowance, or they could take the living annuity as their own living annuity. So essentially set up their own living annuity, use the capital as a starting value, and then they'll be able to decide on an income that they would like from that on an annual basis or month-to-month basis.
Chris, you mentioned golden PGMs. We can throw AI into that as well. And we're not here to pile on active managers at all, but I think there are a lot of folks who are looking at the numbers I'm quoting: 18% on NASDAQ, 30% on the top 40. That's not necessarily going to be everyone's lived expectation in terms of their returns, simply because, particularly locally, you had to be, a quarter of our market is now gold. And it was a brave fund manager who took that position a year ago. And truthfully, it's probably similarish numbers in terms of the Mag 7. In fact, I think a higher number. It's around that allocation into individual stocks and sectors, which can skew turns. It's one thing to see the headline number, but the reality on the ground is often different.
Yeah, that's right. I mean, there are two great points that you raised there. I think the idea and certainly the way we approach things is that we use asset allocation to drive investment outcomes. So the right mix of equities, bonds, onshore, offshore, and ultimately what we're trying to do there is not necessarily outperform an index. We're looking to deliver an actual client investment outcome. So whether that's inflation plus 5.5 over rolling 5-year time horizons, and getting the mix right of those asset classes is really important. Once we focused on getting the mix right, we then really implement that exposure using kind of a range of different indices, because ultimately, to your very point, and this year's been a great example of that, it's exceptionally hard to consistently pick the right underlying shares, whether that's ShopRite or Pick and Pay or Foschini Group, which yesterday came under a little bit of pressure, or how much gold am I holding, or how much aren't I? And what you see is the ability to consistently over long-term periods of time outperform the relative asset class indices becomes incredibly difficult. So that's why, from our perspective, we focus on really on getting the asset allocation right, and then driving the underlying investment strategies through using indexation and index funds, because the probability for clients to get a better outcome is improved from taking that approach. The one caveat I would say, and this is something we've always been somewhat cognizant of from a 10x perspective, is sometimes market cap indices can drive heavy concentration risk. So what are we talking about there? We're talking about a large part of an index being highly exposed to one or two, three shares. I mean, a great example from a South African perspective is if you go back to the 2000s, like Anglos and BHP made up something of kind of 30 to 40% of the market, and two shares with the same commodity drivers. So the whole point of using indices is to get a well-diversified asset class exposure, earn that asset class risk premium through time to deliver that investment outcome. And what you don't want is you don't want the outcome or individually what happens to any one share to skew that outcome. And so from a South African perspective, I mean, at 10x, really since our inception more than 17 years ago, our SA equity carve-out had always historically been capped to limit that index concentration. So what happens to any one company doesn't ruin your investment outcome. And actually that was before the JSE even started launching capped indices. Now capped indices are really sort of the go-to and the standard from a South African equity perspective. And the concentration risk is less, I mean, on a global basis, your point, and I take that sort of 25% exposure to golds and PGM is probably quite a high level of concentration, and one needs to factor that in. But similarly, in the US, you've got sort of that Mag 7. I think the top 10 shares make up something close to 45% of that market, and they're all primarily AI driven. So it's almost like the way that AI and whether they're able to monetize their capital expenditure is going to skew what happens to US equities, and it's going to skew what happens to global equities, because again, you've got sort of 72% of global equities in the US, of which 43% are in the top 10 shares. And
it is that concentration. Brett, I want to bring asset allocation. As a client of yours, could I change my asset allocation? And I want to be careful here, because not in the sense that I want to try and suggest people be traders and they make decisions to try and time the market. But life circumstances change as we age. You might want to tweak that asset allocation within the living annuity. Is that possible?
Yes, it is possible. But as we always say, it's always better to be invested in the market as opposed to trying to time the market. So one of the biggest benefits of a living annuity is you're able to change portfolios at any time throughout the year. You can go from an aggressive fund to a conservative fund, or either way. And I think just going back to the point is, you want to set up the investment at inception for the long term. You want to look at your time horizon. You want to diversify your asset allocation, and you want to make sure that you beat inflation. As we know over history, equities outperform inflation, so you do need to hold some equity. A big misconception I get with new living annuity clients is they've got to that age now where they feel like they need to be extremely conservative, park the funds because this is their nest egg, this is what they've built up. But in actual fact, you need to beat inflation over time, and you need to hold different kinds of asset classes to generate those returns. Like I said, you can switch funds at any time, but essentially from the get-go, you want to try and get in a portfolio that's going to deliver those long-term returns and not chop and change. A real example, for example, was when I had a client who invested about 2 weeks before the Ukraine invasion, and he was down about 15% the next month, and he was in one of the moderate to high equity funds. And he wanted to switch portfolios and say, listen, I don't see any value in this. I want to lock it in. And, we had to go through those emotions. I had to chat to him and say, listen, we put you in this portfolio for the long term. We need to, ride out the ups and the downs. Not every month is going to be positive. You're going to get those negative periods, but it's about, the time that you spend in the market. Now he's up 30-40% and happy, and glad he didn't make the change. So it's about managing the emotions. I think as retirees, you a little bit more emotional about your life savings that you've built up over the last 30-40 years. So yeah, it's nice to have someone you can chat to, like a consultant, where you can speak to them and say, this is what my concerns are, what should we do here, and get some guidance at least.
Yeah, I mean, half of your job, I imagine, is literally being a therapist and talking people off the edge. And remembering, Chris, it brings me to the point that we were talking around gold beforehand. I very smartly got into gold. So I'm like the cleverest oak in the room. And to be clear, I'm also the only oak in this room at the moment. So that was the first decision, and I got it right. My second decision is when to sell. I have no idea. That is hard. And then my third decision is, well, I've got out what to get in next. And that comes into the timing, the market. When we say it's hard, we are underestimating the hardness of it. And actually, the holy grail is not the timing of the market. The holy grail is back to that asset allocation.
That's absolutely right. And so the way that we look at it, even though we build investment portfolios and run investment portfolios, we have absolutely no idea what the next 3 months are going to hold. We don't know what the next 6 months are going to hold. And to be quite honest, I might have a view, but I also don't know what the next 12 months might hold. What we tend to do is we take a step back and we say, okay, let's look at a range of different asset classes. Bonds, you can look at the yields that they're generating. You can look at equity valuations. Now, valuations are terrible timing tools, what you're talking about. They tell you nothing about the next year. But as you stretch that time horizon out and you start looking over 5-year time periods and 10-year time periods, they do become quite powerful anchors for setting rational return expectations across a range of asset classes. Again, with the caveat that it tells you nothing about the next kind of 6 or 12 months. So terrible at timing. And so like the way that we look at the world is we take a step back and we say, okay, our clients are investing certainly in the higher risk products, are investing for a long-term time horizon. We target, let's say in the 10x Your Future Fund, so our high equity balance fund, a rolling 5-year time horizon where we're looking to generate inflation plus 5.5% over kind of every rolling 5-year time period. And we take a step back today and we say, okay, if I had to build a portfolio today that improves the probability of delivering our clients a better real return over the next 5 years, not the last 5 years, not what worked well last 5 years, but over the next 5 years and next 10 years, 15, 20 years, how can we build a portfolio across asset classes that improves the probability of a better outcome over the longer term? And that's really how we think about investing. It's not about getting to the top of the table this year or on the 6-month charts or the next raging bull. It's about how you deliver consistent long-term real returns for clients, because that's what really matters when you want to pay yourself an inflationary increase. And when we look around a range of different asset classes today, there are kind of two big standouts that I think are worth noting. I mean, we touched a little bit on, I think in the intro and some of the previous points around some of the concerns around high valuations in the US. And from the starting point, expectations are over the next 5 to 10 years of zero real returns in dollars to US equities, which is, again, not a view over the next 3 or 6 or 12 months, but as you stretch it out over 5 and 10 years. And actually quite perversely, where there is a fantastic opportunity is actually in South African bonds as an asset class. And that's actually a function of some of the challenges that we have in South Africa. We know that the government has been in sort of a relatively precarious position from debt sustainability and its fiscal position, not bringing in enough revenue, spending too much money, sees our debt kind of ballooning out in terms of the debt to GDP. I mean, we know the stat that about 20 cents of every rand of revenue goes to paying just interest, not actually expenditure, going to paying interest, and that crowds out a lot of government spending. And I mean, we've heard this for the last 5 to 10 years that we need structural reform, monetary policy, consolidate, and we're not going to get into that now. But a function of this elevated risk around South Africa is that investors demand a higher yield for investing in South African government bonds. And if you look at it, you can invest in an inflation-linked bond today that's paying you inflation plus 5. And if you tie that back to the outcome that clients are looking for in a living annuity, which might well be inflation plus 5, That's a fantastic way to deliver that investment outcome with relatively low risk. I mean, if you say a high equity balance fund through the cycle should give you inflation plus 5 to 6, and I can go invest in something that is hedged against inflation from a South African perspective and locks in inflation plus 5, that's an incredibly high hurdle for other asset classes in a portfolio to compete with that investment allocation. So actually, because of sort of the stagnating South African economy and the challenges from a fiscal perspective, there's a great opportunity for savers looking for real returns from South African bonds as an asset class. And as we survey kind of across the world, across different asset classes, I would say those are the two big standouts, that kind of US long-term returns to US equities are challenged from the starting point, and really returns to South African bonds are a lot more attractive than what one would have seen over the longer term. I mean, we've got some data going back to 1900, and the long-term average returns, real returns above inflation to South African bonds is something like 1.5%. You're getting 5% real now, and that shows that sort of big disconnect. But it's not only about the return opportunity. It's important to view that opportunity in the context of the client outcome and what clients are trying to achieve. And in a living annuity, inflation plus 5 in a very kind of low volatile, low risk manner might actually be quite a good decision for where we are in the cycle currently. And I completely agree with Brett. You don't want to be trading markets and trying to time markets, but it's saying, looking out over the next 5 years, I can lock in inflation plus 5 from really something like a low risk income fund. And actually that's I mean, it's not sexy, it's not AI, it's not going to scream ahead and give you 30% returns this year. But in the context of delivering your real income that you need, when equity markets are exceptionally elevated from a valuation perspective, might not be a bad spot to park in until maybe we see more attractive valuations globally, which may be a better entry point to move into a more aggressive portfolio.
Yeah, it's boring. It's completely devoid of FOMO, but it does what someone needs to do, and that's the more important point. Folks, if you've got questions, you're welcome to drop them in. We're coming to wrap up. I'm not seeing any, but I did get one coming through. Brett, asking you, going back to the EAC effective annual cost. I don't see it on my statement. Was the question? How do I find it? Essentially, your provider, you contact them, and they will crunch the number, because it's made up of, it's advisor fees, it's platform fees, it's fund fees, it's a lot of different fees that come into it.
Correct, yeah. So you can get it from your provider. You just ask them directly for the EAC document. They will send it to you, and like you say, it's a summary of all your fees. So you've got an advice fee, you've got a management fee, portfolio fee. There might be other fees like performance fees. But yeah, you can request it directly from your provider. They'll give that to you, and then, like I said, you use that to compare your costs with other providers.
Great question coming through, and I'd never thought of this. Once retiring from an RA or a Reg 28, how long do I have until I need to take out the living or a living annuity? Is there if I retire today and say shutting my Reg 28, what is my time horizon?
Yeah, great question. So I'd say the average transfer from provider is maybe about 6 to 8 weeks. Once we receive the funds from your current provider, we have to pay you the income straight away. So you've got a bit of time to maybe change drawdowns, to change portfolios. But once we receive the funds from your current provider and they're invested into our living annuity, we must pay an income as soon as we get the funds.
There's also, if I retire today, I don't necessarily need to collapse that Reg 28, or do I? I could leave it as, just leave it in the background. I might not be contributing, but I could, I don't know, go on holiday for a year and come back next year and do it. Is that possible?
No, so when you retire from a fund, you're able to take a third or a portion as a tax-free amount, but whatever you don't take must be transferred to an annuity, whether it's a living annuity or a guaranteed annuity.
Question came, I switched to a life guaranteed annuity. Can I still negotiate fees? You're going to have to speak to the provider, Brett. I suspect probably not. You've probably signed into it. Question asking the difference between TER and EAC. TER is total expense ratio. EAC is effective annual cost. Brett, the total expense ratio is a fund fee. as opposed to other fees that then also sit.
Correct. The TR is a portion of the EAC. It's related to the underlying investment portfolio that you're invested in.
Folks are asking if they get more information. The session has been recorded. We'll email you that recording. But Brett, you've also got an ebook which 10x Investments has recently updated. Talk us through that.
Yeah, correct. So we've recently updated the Living Annuity ebook. It's available for everyone. You can email us at retail@10x.co.za if you'd like us to send it to you. Really useful ebook. All information on living annuities, pretty much what we've discussed today. You can get it at retail@10x.co.za. Just pop us an email and we will happily send it through.
Cool. Okay. Retail@10x.co.za. Question coming through. Do you have to lock in the 2.5 to 17% withdrawal only once a year? Why not more flexibility? Brett, that is the law, as I understand.
That's the rules. Yep. You can lock it in at the beginning of the year and then your anniversary will come around. What we do at 10x is we'll send a client an email about a month before their anniversary asking if they want to make any changes. They make the changes that they need to, send it through to us, and then we action that for the upcoming year.
Here's a great question. What's a reasonable EAC for a living annuity?
Chris, you want to answer that one?
Well, Brett, you probably see a lot more of these quotes. I know you guys see a lot of these quotes coming through, but from my perspective, I would say kind of you want it to be below 1%, really. Is from an EAC perspective is ultimately, I mean, we've been talking a lot about real returns today.
Yeah.
But if you only get 3% real from your living annuity and you're paying 3% in fees, you're basically paying away 100% of your real return. So from that context, you want to try and minimize it and really keep them as low as possible.
A great question coming. What happens if the funds in the living annuity that are being transferred are not available at destination provider? In other words, I'm sitting with a living annuity. I decide to move to 10x, but you don't have the same funds. I imagine that's not a problem. I mean, they're going to liquidate it, send it across, and then you would reinvest on your side.
Correct. They'll liquidate it into cash, send it across to us, and then they'll be able to invest in one of the 10x portfolios that we offer. We've got 7 different living annuity portfolios.
Wow. Okay. A question coming, one, a mention of tax. We did chat a bunch about tax up front. Tax is important. I think there are 2 key points, as Chris mentioned. You're within the living annuity, there's no tax on the gains. And then when you draw money out, it is income and taxed accordingly. And another one, frequency of tweaking asset allocation. Brett, I imagine as often as you want, but truthfully, as seldom as possible.
Exactly. Yeah. You want to try and remain invested for as long as possible in your kind of fund that you invest in the beginning. But yeah, you can change portfolios at any time throughout the year.
I mean, maybe just one point to add there, Simon, on that is like across our range of asset allocation portfolios, they target different inflation outcomes over different time horizons. So the defensive is sort of inflation plus 3.5, and the moderates is inflation plus 4.5, and 10x Your Future, our high equity portfolios, inflation plus 5.5. And really, from a client perspective, they kind of want to lock in to an outcome that they're comfortable with. Within those portfolios, we do, through a very long-term lens, look at building the right asset allocation to deliver those real returns with consistency through time. So there is, let's say, management from our perspective of the asset allocations within the relevant sort of risk buckets.
And that fits perfectly into a question which is saying sort of what's a reasonable return over a 5 or 7 year period, and that really is up to the investor, what they're comfortable with, what they're trying to achieve. You know, if I've retired with far too much money, and I'm not sure how that would possibly be a problem, but if I did, I could drop my risk down and go for a low risk. And it is going to be, you know, what the return is going to depend what the investor is looking for, and the level of risk, and importantly, volatility that they're prepared to take, Chris.
Absolutely. And I mean, that's it. From our perspective, you've got the defensive fund is, as I mentioned, inflation plus 3.5, but that's over a rolling 3-year time horizon. So there's more certainty around delivering that. Whereas the 10x Your Future portfolio is 5.5, so much higher long-term returns, but that comes with much higher allocation to growth assets, which comes with much higher volatility over the short term. And as a result, we're looking to deliver that inflation plus 5.5, not over a rolling 3-year time horizon, but over a rolling 5-year time horizon. Because as you stretch the time horizon out, you can almost think of it as like a cone. The range of returns start narrowing over time. A 100% equity portfolio any day has about a 51% probability of being up or a 49% probability of being down. So that's almost like evens. And as you stretch that time horizon out with kind of growth assets, you have more higher and higher certainty of ending up with a higher long-term return. So again, just about managing expectations there and based on the amount of risk that clients are prepared to assume.
Yeah. Brett, a question coming through. We've been talking sort of retirement, which is the annuities, mostly living. We've touched a bit on guaranteed annuities. Question coming through, what about Reg 28 products ahead of retirement? Does 10X offer that? Certainly you do. And another question which someone else was asking is, can I take a Reg 28 product in my retirement to reduce my tax?
Yes, you can. I often see investors do this. If they want to offset some of the tax that they pay on their living annuity, you're never too old to open a retirement annuity. Whether you want to contribute on a month-to-month basis or do lump sums throughout the year or do a combination of the two, it is a very powerful tool for offsetting some of the tax that you'll pay on the living annuity. So yes, you can.
Yeah, I think I met someone, they were in their mid to late 70s and they took out a new RA, which seemed wild, but the logic was perfectly sense. Great question. I'm 54.
Sorry, just to add to that as well, what's nice is you can always add that retirement annuity back into the living annuity down the line, or even open a new one. So you can almost recycle it back, and then you increase your living annuity value, which is fantastic for long-term investing.
Yeah. Great question. I'm 54. When I retire at 65 from my employer, can I leave my RA? Can I sort of shift the RA to 10X and leave it until I'm 75? In other words, move it across, make it dormant, and then technically retire at 75 rather than 65.
Yeah, correct. But if you're leaving a company pension or provident fund, it will most likely go into a preservation fund. And
correct.
Yeah, it's in the name, preservation fund. You're going to preserve those assets until you retire. And then from there, you can convert that preservation fund into a living annuity.
I'm not seeing any more questions that we haven't covered. I think I've got them all covered. As I said, we will send out the recording tomorrow. There'll be contact details about 10x.co.za. There's the contact details there. You can drop them a mail, send them a call, speak to a consultant. retail@10x.co.za. Drop them an email. You can request the updated ebook that they've had. Would your record of entering into would prevent? Okay, so that we've answered already. So we'll leave it there. Chris Eddy, head of investments, Brett McKay, investment consultant, 10X Investments. Thank you both for your time. Ladies and gents, really appreciate your time today. Hopefully we answered your questions. If not, as I said, contact the guys at gals and girls at 10X. They can certainly answer those later. Everyone, thank you very much for your time.